Hi, and thanks for watching episode 6 of our Trader series. My name is Vincent and I work at Maven. Today I would like to discuss bonds. As you might recall, bonds fall in the category of debt. We discussed the equity classification a couple of times before in stocks, indexes and ETFs. In the category debt or fixed income, we have to discuss bonds a little bit. Well, companies or countries can raise money, and they do that typically by issuing bonds. Any investor, basically like you and I, can buy these bonds. And how bonds typically work, they have some sort of end date. It's kind of a loan for a particular amount of time, could be a month, could be a year. And at some point, the country at stake or the company will buy them back at face value. And face value is typically, let's say, $100 or something. So you invest in something, and at some point in time, they will buy, the company or country will buy it back at 100. So you can imagine you have to, or you can buy a bond today for a price less than 100, let's say 99 or something, and in a year's time, you can sell it back for 100. So basically you buy it for a bit lower price and you sell it out for a higher price. And basically the small profit you made there, that can be considered the interest compensation for the service, right? Because the company in question or the country kind of has your money, can do nice things with it, but in the meantime, they need to compensate you for the service. Some of these bonds pay periodic coupons. So that means like every quarter or every whatever period, in the meantime, between now and the maturity date of the bond, an actual interest payment is made by the country to the private investor. But some of them don't at all, and these ones are a bit more easy to discuss, and I would like to stick with those bonds today. They are called zero coupon bonds. So you buy the bond at a discounted value, and only at the last day there's one single final payment, the face value, which in our case could be 100. So let's check an example. So imagine we have such a zero coupon bond and the face value is 100 and the maturity date is 2 years. So this would be a simplified formula of what the value of such a bond would be today, and it includes the face value. That's, remember, it's the number the country will pay you at the end of the maturity back. And there's, of course, the value will imply a certain interest rate. So let's check these two examples. So let's say the face value is 100, and you could buy this particular bond for a price of 96.12. This implies an interest rate of 2%. So in this particular example, the country in question or the company will compensate you for a 2% annual interest rate. In this case, this sums up to a 3% interest rate. So what you can see, the cheaper the bond becomes today, the higher interest rate that implies. And that makes some sense. If you think about it, let's say you can buy something for 94 now, and the company will give you 100 back later on. The compensation is a higher interest rate, where here you have to pay 96. So the difference between 96 and 100 is only 4. So that implies a smaller interest compensation. So what we say in finance is that the value of the bond is the present value of the final face value. That's how we would say it. So let's say there's a risky investment. A country has to pay 5, 6 or even 7% as a compensation. You could buy the bond very cheaply today. Okay, so these are two pictures to illustrate the dynamics a little bit. So here we are looking at the price of the treasury bonds. The treasury means it's the US 10-year maturity bonds. You can see how it moved over the course of a couple of years. And this graph is the actual yield. So what's the annual interest rate compensation of the same thing? And you can see both graphs are kind of mirrored, as I told you before, right? So the bond, the value of the bond, the lower this number becomes, the higher the actual interest rate becomes. And investors are much more used to talk in terms of this interest rate component than the actual face value, than the number itself. So they say, the interest rate or the yield, the implied yield is 1%, 2%, 3%. So in that sense, people look much more at this graph than at that graph itself. So here you can see, it's a bit small to read, but I'll tell you, 2018, 2019, 2020, and this is today. You can see the yield moving around. So it went down here, and right now the interest rates are on the rise in 2022, which is probably something you are quite familiar of. I know. This is a screenshot of interest rates across different regions in the world, and if bond issuers are credit-worthy, as in trustworthy, or there's not a lot of turmoil in the company or in the country at issue, they are able to raise money at a lower compensation. So think like very safe and stable large countries like Germany and the US, they are able to raise money for a relatively low annual interest rate, whereas some countries there might be a bit more turmoil, there's a bit of uncertainty. If they want to raise a certain amount of capital, they have to compensate for a little bit of a higher yield. So you see a couple of countries listed here, you see the current yields, and these are the interest rate compensations. So for example, a country like Switzerland is considered rather safe. So you see a very low number there. There's only 0.4% yield priced in, and these are bonds maturing in 10 years. So if you are lending your money to Switzerland for 10 years, you get only 0.4% interest rate for the surfers. But for example, a country like Mexico is already 4.5%. So if you invest in a country like Mexico, you get a bigger compensation, but most likely there's a bit more risk involved than if you would invest in Switzerland. You can see how the last 3 months these rates kind of change. So you can see for Brazil, between now and 3 months ago, the yields were kind of fluctuating between 5.3 and 6.5. And well, you can see it for each other country. Feel free to pause the video to go through the slide. Okay, last slide for you. When do bonds actually move? Why do they move at all? First of all, we have central banks setting monetary policies, setting the actual core interest rate. Here you can see a couple of central banks, the black line, for example, the Fed, the US central bank, and you can see, and on this axis you see actually the interest rates, and you can see how they were actually lowering interest rates into COVID times, and right now they're kind of rather aggressively hiking the interest rates back again. And you can see it on the graph here itself. The yellow line is the S&P index, so basically the stock market, and the white is the actual yield on the 10-year treasuries. So you can see that right now interest rates are on the rise, but the stock market is kind of declining a little bit. That's what we see currently. So typically central banks change rate policies, that will cause bonds to move. And a second reason, when there's uncertainty in the market, people tend to move away from the equity investments. Because you might remember how I said that investment in stocks is a bit more risky than an investment in debt, in fixed income. So if there's a lot of uncertainty in the market, you will see stocks going down and bonds going up, because people tend to fly into bonds. So hopefully this gave a bit of an insight into debt and fixed income. In summary, bonds trade the value as present value of a future payout, some dynamic which we will see in the next episode as well. And when times are volatile, people tend to escape equity and run into debt. Well, stay tuned for more episodes, and I hope you enjoyed the video.